Welcome to your essential guide to understanding the stock market. For many, the stock market seems like a mysterious, complex world, filled with jargon and high-stakes decisions. But at its core, it's a powerful tool designed to help you grow your wealth and participate in the success of companies you admire. The stock market is simply a place where you can buy and sell tiny pieces of ownership in publicly traded companies. Think of it as a global marketplace for company shares. Its primary purpose is to empower individuals like you to make informed financial decisions and build a more secure future. While it might appear intimidating at first glance, breaking it down into understandable pieces reveals its true potential. This guide will demystify the stock market, transforming it from a source of confusion into a clear path for your financial journey. We're here to make sense of it all, step by step. So what exactly is a stock? In its simplest form, a stock or a share represents a small piece of ownership in a company. When you buy a stock, you're not just buying a piece of paper. You're becoming a part owner of that business. This makes you a shareholder, aligning your financial interests with the company's success. As a shareholder, you gain certain entitlements. You might receive a portion of the company's profits, often distributed as dividends. Additionally, you hold a claim to a portion of the company's assets. This means that as the company grows and becomes more valuable, so too does your investment. It's a direct way to participate in the economic growth of leading businesses. The stock market's core function is to facilitate the buying and selling of these company shares. It provides a regulated and organized environment for these transactions to occur efficiently. This global network connects buyers and sellers from all corners of the world. Major stock exchanges are the central hubs where these trades happen. You've likely heard of the New York Stock Exchange, or NYSE, known for its iconic trading floor. Another prominent exchange is NASDAQ, which is largely electronic and home to many technology giants. Investors don't directly buy and sell shares from each other. Instead, they use transaction intermediaries called brokers. These brokers execute your buy and sell orders on the exchanges, making the process seamless and accessible. Stock prices are constantly fluctuating, driven by the fundamental principles of supply and demand. When there are more buyers interested in a stock than sellers, demand exceeds supply, and the price tends to rise. Conversely, if there are more sellers than buyers, supply outstrips demand, and the price typically falls. This dynamic interplay of supply and demand is what determines a stock's value at any given moment. Understanding this basic mechanism is crucial to grasping why prices move the way they do. It's a continuous auction where buyers and sellers meet. To navigate the stock market effectively, it's important to understand some key concepts. First, let's talk about an index. An index tracks the performance of a group of stocks, providing a snapshot of a specific market segment or the overall market health. For example, the S&P 500 tracks 500 of the largest U.S. companies, offering a broad view of the American economy. The Dow Jones Industrial Average, or DJIA, follows 30 significant U.S. companies. These indices help investors gauge market trends. A bull market is a period characterized by rising stock prices, strong economic growth, and widespread investor optimism. It's a time when confidence is high and investments generally perform well. Investors often feel positive about their prospects during a bull market. On the other hand, a bear market is defined by declining stock prices, economic downturns, and investor pessimism. During these periods, confidence is low, and investments may struggle. It's a more challenging environment for investors. Volatility refers to the degree of price fluctuation in a stock or the broader market. High volatility means rapid and significant price changes, which can present both opportunities and risks. It indicates how much a price moves up or down over time. Dividends are a portion of a company's profits distributed to its shareholders. These payments are typically made quarterly and can be a valuable source of income for investors. Not all companies pay dividends, but for those that do, it's a tangible benefit of ownership. Finally, market capitalization, or market cap, is the total value of a company's outstanding shares. You calculate it by multiplying the current share price by the total number of shares available. Market cap helps categorize companies by size, from small cap to large cap. Getting started in the stock market is more accessible than ever before. Your first step is to open a brokerage account. Many reputable online platforms offer commission-free trading, making it affordable to begin your investment journey. Once your account is set up, the next crucial step is to conduct thorough research. Don't just pick companies based on hype. Investigate their financial performance, industry trends, and competitive landscape. Understanding what you're investing in is paramount. Step 3 involves choosing investments that align with your personal goals and risk tolerance. You can invest in individual stocks, but also consider exchange-traded funds, or ETFs, which are baskets of stocks, or mutual funds, professionally managed portfolios. Diversifying your choices is a smart strategy. After you've decided what to buy, you'll place your order through your brokerage account. This is where you specify the number of shares you want and the price you're willing to pay. Your broker then executes the trade on your behalf. Finally, step 5 is to monitor your investments regularly. Keep an eye on how your chosen companies are performing and make adjustments as needed. The market is dynamic, and your portfolio should reflect your evolving financial situation and goals. Investing in the stock market involves inherent risk. It's crucial to understand that you can lose money due to price fluctuations. There are no guarantees, and market values can go down as well as up. To mitigate this risk, diversification is key. Spreading your investments across different stocks, industries, and asset classes helps reduce the impact of a poor performance by any single investment. Don't put all your eggs in one basket. The stock market is generally considered a long-term investment. While short-term gains are possible, significant wealth building often occurs over many years. Patience and a long-term perspective are vital for success. It's also important to avoid impulsive decisions. Don't react to every short-term market fluctuation or news headline. Emotional trading often leads to poor outcomes. Stick to your well-researched investment plan. This overview has provided you with foundational knowledge about the stock market. You now understand what a stock is, how the market operates, and key concepts that drive its movements. This basic understanding is your starting point. However, further education is crucial for making truly informed investment decisions. Continue to read, learn, and expand your financial literacy. The more you know, the more confident and successful you'll become. For personalized advice tailored to your unique financial situation and goals, consider consulting a qualified financial advisor. They can offer expert guidance and help you navigate the complexities of investing. Your financial future is in your hands, and continuous learning is your most powerful tool.